The TFSA is one of the most misunderstood accounts in Canada. Most people think that it is just a savings account with a fancy name. That completely misses the point. A TFSA lets you grow your money tax-free. You can invest in stocks, ETFs, and real estate funds. When you take the money out, none of it touches your tax return. No income limits, no tax on the way out. No explanation needed. Hi everyone, I'm Armakan. I'm a CPA in Canada who loves to talk about money, investments, and taxes. If that is something that you're interested in, why not subscribe to the channel? So let's start with the very basic question. What is a TFSA? TFSA stands for Tax-Free Savings Account. The Canadian government created this in 2009 to help Canadians grow their money without paying tax on the gains. Despite the name, a TFSA is not just for savings. It can hold a wide range of investments. Think of it as a container for your investments. Anything that grows inside that container stays completely tax-free. Let me show you what that means in real numbers. So you buy an ETF inside your TFSA for $5,000. 2 years later, it is worth $8,000. You can sell it, withdraw the money, and pay zero taxes. No capital gains tax, no paperwork, nothing to report to CRA. In a regular investment account, that same $3,000 of growth would get taxed based on your tax bracket. Over time, those taxes add up. The TFSA protects you from that. The tax-free treatment applies to everything inside the account. Capital gains are tax-free, dividends are tax-free, interest is tax-free. You can reinvest, withdraw, or leave the money in cash. Whatever you do, everything stays tax-free. To open a TFSA, you must be 18 years or older, a Canadian resident, and have a valid SIN. There is no income requirement. It does not matter if you work part-time, full-time, or not at all. If you moved to Canada recently, your contribution starts from the year you became a permanent resident. If you arrived in 2024, you would have room for 2024, 2025, and 2026. Once you are eligible, you can open a TFSA at any bank, credit union, or online brokerage. Most banks will default to a basic savings account that earns 1 or 2% interest. Online brokerages like WealthSimple or Questrade will let you invest in stocks and ETFs as well. I am making a separate video that compares these investment platforms. I will link it in the description below for you. Every Canadian over 18 gets new contribution room every year. For 2026, the limit is $7,000. That amount is the same for everyone. It does not matter how much you earn. If you have never contributed before, and if you have been eligible since 2009, your total room is now $109,000. That is every annual limit added together. You can catch up all at once if you have the money. Unused room carries forward, it does not expire. If you only contribute $2,000 this year, the remaining $5,000 gets added to your next year's contribution limit. You do not have to invest right away. You can deposit cash and decide what to do with it later. But the real benefit comes from growth. The tax-free advantages only kick in when your money starts earning returns. Now let me explain the part that trips people up. When you take money out of your TFSA, you get that room back, but not right away. You have to wait until January of the next year before that space is added back to your limit. So let me give you an example that clears this up. Sarah has a limit of $50,000 and she has already contributed the full amount. In July, she withdraws $10,000 to cover a car repair. In October, she gets a bonus and decides to put that $10,000 back. She might think that the space is available because she just took it out, but that $10,000 does not get added back to her limit until January 1st. She did not have the extra room left, so she just over-contributed. CRA charges 1% penalty each month on the excess amount. If Sarah goes over by $10,000 and does not fix it for 3 months, that is $300 in penalties. To check your limit, log into your CRA My account. The number there is not always current. If you have made recent deposits, they might not show up there. The best approach is to keep your own records. Know how much you have contributed and what you have taken out. So let's see what we actually can do with our TFSA. The power of the TFSA comes from tax-free growth. Leaving it in cash, earning 1%, defeats the purpose. The simplest approach is to invest in a broad, diversified ETF, something like XEQT or VEQT. These give you exposure to thousands of companies around the world in a single purchase. You buy it, hold it, and let it grow. Over time, the gains compound and you pay zero tax on it. Let me show you what consistent contributions can do. Meet Priya. She is 25 years old and just opened her first TFSA. She decides to contribute $500 every month into XEQT. Assuming an average return of 7% per year, here is what happens. After 10 years, Priya has contributed $60,000. Her portfolio is worth roughly $86,000. This is $26,000 in tax-free growth. After 20 years, she has contributed $120,000. Her portfolio is worth $260,000. That is $140,000 in gain she will never pay tax on. After 30 years, Priya has contributed $180,000 in total. Her portfolio has grown to roughly $580,000. In a regular taxable account, Priya would owe capital gains tax when she sells. Depending on her tax bracket, that could be $50,000 or even more. The TFSA lets her keep every dollar of gain tax-free. The specific investment strategy depends on your goals, but the main point is simple. Invest your TFSA. Do not let it sit in cash. I have a separate video on the CRA audit trigger points for 2026, and the TFSA investments is also part of it. The TFSA gives you a lot of freedom, but if you use it the wrong way, CRA can actually step in. Let me explain how. If you buy and sell too often inside your TFSA, the activity can start to look like a business income. CRA does not publish a specific number of trades that triggers an audit, but it is not about volume. It is about pattern. If your activity looks like you are running a business inside the account, CRA can deduct your gains and no longer offer a tax-free option. They will tax it as income. This has happened before. People have lost the tax-free status of their TFSA because they were flipping stocks every few days or day trading from inside the account. Once CRA decides your TFSA is being used as a business account, you do not just pay tax on new gains. They can go back and reassess prior years as well. You might owe tax, interest, and penalties. The way to avoid this is straightforward. Stick to long-term investing. Hold your positions, rebalance when you need to, collect dividends, let your ETFs grow. All of that is fine. If you are trading every day or trying to time the market, that is where the risk starts. Most Canadians will never run into this issue. But if you manage your own account and do a lot of buying and selling, keep records and know that CRA looks for these things. Let's quickly go over the common mistakes that you can avoid easily. The most expensive mistake is over-contributing. This happens when you put in more than your available room. CRA charges 1% per month on the excess until you remove it. Even small over-contributions get expensive if you leave them sitting there. The second is redepositing too early. I covered this with Sarah's example earlier. If you withdraw money and put it back in the same calendar year, you need to have room available. If you do not, you are over the limit. That triggers the same penalty. One more thing that people miss: if you have a spouse or a common law partner, name them as a successor holder for your TFSA, not just a beneficiary. As a successor holder, they can take over the TFSA directly without affecting their own contribution rule. The account stays intact and tax-free. If you only list them as beneficiary, the money still transfers, but any growth after your death could get taxed. It is a small detail, but it matters a lot in long term. So looking at the big picture, if you're not sure where to start, here is what I tell most people. Pick one goal, growth or income. Choose one ETF that fits your goal. Automate your contributions. Even if it is just $100 a month, put it on autopilot. Make it consistent. You do not need the perfect setup to benefit from the TFSA. You just need to get moving. In case you are feeling stuck, the two videos on your screen will help you take the next step. Click on one of them and I will see you in the next one.